When you watch a rocket launch, all you really see from the ground is this incredible soaring trajectory.
Oh, absolutely. It's spectacular.
Right. Like, it is just this massive pillar of fire punching through the clouds, basically defying gravity.
But if you were actually sitting inside mission control, you wouldn't just be cheering at the visual spectacle. You would be staring intently at the telemetry.
Sweating over the fuel gauges.
Exactly. You'd be constantly doing the math and praying they don't run out of propellant before they actually establish a stable orbit.
Okay, let's unpack this, because that is the exact paradox we're looking at today in this deep dive into Redwire Corporation.
It really is a masterclass in financial tension.
Yeah. For context, Redwire, ticker RDW, is a company operating at the absolute bleeding edge of space infrastructure, defense technology, and in-space manufacturing. And looking at their second quarter of 2026, the financial contrast is just staggering.
It's wildly contradictory.
Right. I mean, on one hand, the stock is up nearly 78.8% year to date. They are posting this jaw-dropping revenue growth that has Wall Street paying very close attention. But on the other hand, their trailing 12-month net margin is sitting at a deeply negative 80.9%.
Which is the ultimate test for you as an investor or even just an observer of the new space economy.
Yeah.
You are looking at a business that is undeniably growing its top-line revenue at a blistering pace, securing contracts that, frankly, read like science fiction. But the bottom line is currently bleeding cash.
So the real question becomes, do you trust the trajectory of the rocket, or do you worry about the fuel tank?
Exactly. And I think we have to start with the bull case before we can really understand the risks. We need to know why the market got so incredibly excited in the first place.
Yeah, let's get into the top-line revenue first, because the Q2 2026 numbers are undeniably impressive. Revenue hit $117.1 million for the quarter.
It was a massive 89.6% jump year over year.
Huge.
Yeah.
And they didn't just edge past analyst consensus, they completely crushed it. I mean, the street was looking for about $107 million.
Right, and if you zoom out to the first half of 2026 as a whole, revenue is sitting at a massive $214 million.
So the top-line growth is phenomenal.
It is phenomenal. But, for anyone dissecting a manufacturing business, that raw revenue isn't actually the standout metric from the sources.
Oh, interesting. What is?
It's the gross margin inflection. Back in the second quarter of 2025, Redwire's gross margin was deeply negative at 30.9%.
Yikes.
Yeah, but fast forward exactly 1 year to Q2 2026, and that has flipped to a positive 27.8%.
Wait, meaning they finally figured out how to build their products without losing money on the assembly line?
Precisely. Because if you have a negative gross margin, it basically means if you sell a widget for $100, it's costing you $130 just in raw materials and labor to actually make it.
And that's before you even pay for your corporate offices or, marketing or your executive salaries.
Exactly. A negative gross margin is a complete death spiral if you try to scale it. So flipping to a positive 27.8% means the core unit economics are finally viable.
How do you achieve a swing like that in just 12 months?
Well, usually in these capital-intensive hardware businesses, it happens when you transition from building bespoke, custom-engineered prototypes into standardized production.
So economies of scale kick in.
Right. You achieve economies of scale, you lock in better supply chain pricing, and you basically stop reinventing the wheel for every single order.
And what they are building is genuinely fascinating. We aren't just talking about, generic satellite antennas here.
Oh, definitely not.
They reported a record backlog of $542.1 million. And one of the items driving that demand is the upcoming 2028 SpaceX Starfall mission.
Which is a massive deal.
It is. They're going to utilize 32 of Redwire's pool boxes for this commercial mission. And this requires a bit of an explanation because in-space manufacturing sounds futuristic, but it's happening right now.
It really is the frontier of industrial manufacturing. You see, when you manufacture something on Earth, gravity inherently interferes.
Right. It causes physical issues.
Yeah, buoyancy, convection, sedimentation. If you are trying to mix certain pharmaceuticals or grow a silicon crystal for a semiconductor or pull fiber optic cables, gravity introduces these microscopic flaws into the structure.
But if you put that same manufacturing process inside one of Redwire's peel box platforms up in microgravity, you remove those flaws.
Exactly. You can grow perfectly structured protein crystals for drug development. or manufacture fiber optics that transmit data significantly faster than anything made down here on Earth.
It's wild to think about. It is not just a cool science experiment for astronauts. It is highly lucrative industrial infrastructure. That's why SpaceX is allocating space for 32 of these units.
And importantly, Redwire isn't solely reliant on the commercial space sector, which is notoriously unpredictable.
Right. They're actively diversifying into terrestrial defense, which gives them a much more stable revenue floor.
Yeah, that massive $542 million backlog also includes multi-year contracts for the Penguin UAS.
Those are essentially advanced drones.
Exactly, unmanned aerial systems. And they secured high eight-figure contracts from a NATO country for those, plus agreements with the Taiwan Coast Guard.
And follow-on awards for their Stalker Block 30 drones for the U.S. Marine Corps and Army Aviation Center.
Right, so they have real-world traction across multiple domains.
But let me push back a little here.
Sure.
I'm looking at this $542 million backlog, and it kind of reminds me of a wildly popular new restaurant.
Okay, how so?
Well, you know, they have a 2-year waiting list, lines around the block, everyone wants a table. It sounds amazing on paper.
Right, huge demand.
But if the kitchen costs so much to run that they ultimately lose money on every steak they serve, isn't a bigger backlog just a bigger problem? Like, you're just stacking up unprofitable obligations.
If we connect this to the bigger picture, that is a great analogy.
Yeah.
But we have to push it a step further for the defense and aerospace sector.
Okay, I'm listening.
It's like a restaurant where you have to custom build a brand new multi-million-dollar oven for every new dish you put on the menu.
Oh, wow. Yeah, that changes things.
The backlog absolutely proves demand. They have a book-to-bill ratio of 1.42.
Meaning for every dollar of revenue they actually recognize today, they're booking $1.42 in new orders for tomorrow.
Exactly. But the real test is execution. You know, Redwire operates with a somewhat narrow competitive moat in a very fragmented defense market.
Going up against massive legacy prime contractors who have infinitely deeper pockets.
Right. Securing a $500 million backlog is a massive victory, but delivering on it profitably is an entirely different operational challenge.
Which perfectly explains why, despite bringing in $117 million this quarter and winning all these high-profile contracts, the company is still bleeding cash.
It's the gravity problem.
Yeah, if you look at the generally accepted accounting principles, the GAAP numbers for Q2, they reported a net loss of $41 million.
Now, to be fair, that is a $56 million improvement compared to the same quarter last year.
True, they are staunching the bleeding, but it still resulted in an earnings per share miss. They posted negative 19 cents per share, and analysts were modeling for negative 15 cents.
And this is where we have to unpack the trailing 12-month, or TTM, data. It acts as this heavy historical anchor weighing down the current narrative.
Because despite that brilliant 27.8% gross margin win we just discussed, their TTM gross margin is still a meager 9.18%.
Right. That rolling average is dragging all the weaker, highly unprofitable quarters from late 2025 into today's picture. Their TTM earnings per share is an alarming negative $2.26.
And if you zoom out even further to capture the real operational trend, their average operating margin over the last 5 years is negative 28.8%.
Which tells you they're trapped in a massive, ongoing infrastructure build-out. They can't just rest on their laurels.
Yeah, they spent $12.5 million purely on research and development in Q2 alone.
You just can't build the future of space infrastructure without a massive R&D budget.
But that heavy spending is exactly what is keeping their adjusted EBITDA in the red, at negative $3.2 million.
And adjusted EBITDA is a crucial metric here. It stands for earnings before interest, taxes, depreciation, and amortization.
Meaning it's a look at the actual operational cash flow of the day-to-day business, stripped of all the accounting adjustments and debt servicing.
Exactly. It answers the fundamental question, can this business sustain itself? And right now, the answer is no.
So if I'm an investor looking at a company burning this much cash, how do I know they won't just run out of money before they finish building all these space modules for SpaceX?
That is the existential fear for any capital-intensive business.
Yeah.
But if you look at the vastly improved financial health data and the sources, there's a lot of reassurance.
Right. Their balance sheet shows a massive liquidity runway. At the end of Q2, their total liquidity sat at $607.8 million.
Which is up 366.9% from the end of 2025. They basically quadrupled their cash cushion.
And they didn't just hoard that cash. They actively paid down their term loans, slashing them from $90 million down to $50 million.
Exactly. This liquidity jump is vital. Whether that came from a strategic capital raise or expanding their credit facilities, having over $600 million buys you something incredibly valuable in aerospace.
Time.
Yes, time. It gives Redwire the vital runway they need to burn through this intensive R&D phase and actually reach a point of sustainable profitability.
Without facing a sudden, catastrophic cash crunch that forces them to dilute shareholders or take on toxic debt.
Precisely.
So they have the capital to survive the near term. Wall Street must be breathing a sigh of relief, right? Are we seeing that confidence reflected in the stock price?
Well, the volatility here is nothing short of violent.
Yeah, the stock is currently priced around 13.49, but it carries a beta of 3.21.
And for anyone unfamiliar, beta measures how much a stock swings compared to the broader market. If a boring utility stock has a beta of 1, it moves perfectly in sync with the S&P 500.
So a beta of 3.21 means the stock is wildly reactive. I mean, it is down 49.4% from its May high of 26.64. It practically got cut in half in a matter of months.
But yet, it is still up 177% from its 52-week low.
What's fascinating here is how the market is struggling to price in the tension between that massive growth potential and the current lack of profitability.
And you can see that struggle clearly in their valuation multiples. They currently have a price-to-sales ratio of 8.84.
Which is incredibly high for a manufacturing business. Most traditional industrial companies might trade at 1 or 2 times their annual sales.
Right, so paying nearly 9 times sales means investors are paying a massive premium for future growth on a loss-making company.
And their price-to-book ratio sits at 2.82.
Yeah, price-to-book simply compares what the market thinks the company's worth against the literal physical value of their assets, like if you sold off all their facilities and inventory today.
When you combine these metrics for a company with a deeply negative net margin, you realize investors are basically buying the 2028 reality today, assuming nothing goes wrong in the interim.
That is the danger of being priced for perfection. Any stumble in execution, any delay in a major contract is punished severely by the market because all the future success is already baked into the current price.
And you can see that anxiety playing out in the analyst community. There is a real tug of war happening.
Oh, absolutely.
For instance, Canaccord Genuity maintained a buy rating on Redwire and actually raised their price target to $15. They clearly believe in the long-term backlog conversion.
But then you look at Jefferies. They downgraded the stock to a hold.
But strangely, at the exact same time, they raised their price target from $13 all the way up to $24.
It sounds totally contradictory on the surface, doesn't it? Upgrading the price target, but downgrading the recommendation.
It does. It feels like they are just hedging their bets.
It makes complete sense when you factor in the timeline and the violent run-up the stock just experienced. Jeffrey's argument is essentially that the incredible 220% rally earlier this year has already captured the upside of the bull case.
So they are saying, yes, fundamentally, if this company executes on its $542 million backlog, it is eventually worth $24 a share.
Right. But right now, at today's valuations, the current price leaves absolutely zero room for disappointment in the near term. The easy, speculative money has already been made.
So they downgraded it to a hold until the actual business fundamentals catch up to the market hype.
Exactly.
Here's where it gets really interesting, though. The insider trading data perfectly mirrors this confusion. If you look at what the executives and board members are doing with their own money, it's a bizarre puzzle.
It really is.
Over the last 90 days, insiders net sold over 373,400 shares. Usually when you see that kind of volume being dumped, it's a glaring red flag. You assume the C-suite knows something bad is coming.
But if you look closer at the actual transaction data, more individual insiders actually bought stock than sold it. There was a highly positive MSPR of 78.64.
Right, which means there were almost an equal number of buying transactions to selling ones. How do you have massive net selling by volume, but more individual people buying than selling?
Well, what this contradictory flow likely represents is a few major executives or early venture backers taking large profits off the table after that massive 177% run-up.
Which makes sense. If you have been holding the stock since it was under $5 and it spikes past 20, it is simply prudent portfolio management to cash out some of your chips.
Exactly. That creates the large volume of net shares sold. However, the fact that there are more individual buying transactions tells us that a broader, wider base of the management team is still actively buying in with their own paychecks.
So it's profit-taking at the very top, combined with continued conviction across the broader organization.
Precisely.
So, with the bull and bear cases clearly laid out, Let's pivot to what listeners should look for next to see which side will ultimately win out.
Well, there are a few major catalysts on the horizon.
Q3 2026 earnings seem like the ultimate make-or-break moment. Analysts are looking for a $122.64 million revenue consensus.
Right, they need to show execution on that backlog conversion. Plus, they have broader macro tailwinds, like the rising NATO defense spending we mentioned earlier.
And they also just announced a new commercial partnership with Kanematsu for expansion into Japan's space market, which is huge.
Those are all excellent operational milestones.
Right.
But financially, there is a single most critical path to recovery and sustained stock growth for Redwire.
The race to break even.
Exactly. They have to achieve sequential quarterly improvement in that adjusted EBITDA we discussed earlier.
They have to prove they can build these satellite modules and drones without needing to dip into that $600 million cash reserve just to survive the month.
Right. Jefferies doesn't expect it to turn positive until 2027. That is the baseline expectation. But if Redwire can hit break-even by Q3 or Q4 of this year, 2026...
It could fundamentally re-rate the stock, couldn't it?
Oh, absolutely. It would silence the bears and fully justify paying 9 times sales for the company.
But there is a massive macro risk here that could completely derail that timeline, and it goes back to that $542 million backlog.
The inflation risk.
Yeah, the equity research specifically flags inflation volatility as a major macro risk noted in Redwire's filings.
And this is crucial for capital-intensive long-cycle manufacturing.
Right, because if you sign a fixed-price contract in 2024 to deliver a complex space module in 2028, and inflation suddenly spikes the cost of aluminum, titanium, and specialized labor over those 4 years.
Your profit margins vanish before you even ship the product. You are contractually obligated to deliver, but it costs you twice as much to build.
It's the silent killer of backlogs.
Capital-intensive businesses with multi-year delivery timelines are just highly sensitive to these macroeconomic shifts.
So, what does this all mean for you, the listener? I mean, the story of space infrastructure building the physical architecture for the next generation of satellite communications is incredibly compelling.
It really is.
But that 49% pullback from the May highs is a blaring siren. It shows that the broader market's patience for unprofitable growth is wearing thin.
To provide a balanced final assessment, Redwire is a genuinely mixed picture.
Yeah.
The fundamental trajectory is undeniably improving. You cannot argue with 89% revenue growth, a flipped gross margin, and massive liquidity.
Right.
But bottom line profitability simply hasn't arrived, and the stock valuation currently leaves very little margin of safety if execution falters.
Which means patience and waiting for those Q3 2026 results to actually confirm the EBITDA trajectory is the disciplined approach here.
And this raises an important question to leave you with, one that extends far beyond just Redwire.
Oh, what's that?
In an emerging industry like space manufacturing, where contracts are signed years in advance, like the 2028 SpaceX Starfall mission, who is the ultimate winner?
Yeah.
Is it the company with the absolute best technology? Or is it simply the one that can survive the cash burn valley of death long enough to see its technology launch?
That really is the million-dollar question. Because the most brilliant in-space manufacturing patent in the world is worthless if you can't afford to keep the lights on long enough to build it.
Exactly.
I'd encourage you to ponder how macroeconomic factors, like that inflation volatility we talked about, might impact companies heavily reliant on long-term backlog conversion. Well, thanks for joining us on this deep dive.
We'll catch you next time.